One of the key themes that have been emerging over the last 12 months has been this concept of a debasement trade. Before even Trump got into power, one of his key advisors wrote a paper called the so-called Mar-a-Lago Accord. And the idea was a coordinated dollar currency devaluation to help make American Rust Belt more competitive again in the global markets. Furthermore, the idea was to stimulate the economy and get the growth rate up that's going to help real wages improve for ordinary Americans. So Trump had long argued that foreign countries like China had been manipulating their currency markets to make Chinese goods more competitive globally. To address these perceived imbalances, Trump's policy has been twofold. One, to introduce tariffs globally, and second, to call out so-called currency manipulation. The concern was that if done in a coordinated way, like the Mar-a-Lago Accord implies, this could be a steady and gradual devaluation. But if done in an uncoordinated way, it could be a sudden and rapid step change. Now, if you add on to that all the kind of conspiracy theorists around, is there actually enough gold in Fort Knox to go around? Are the emerging countries, the BRICS countries, going to deliberately try and de-dollarize their economies? Is fiat money all just a figment of the imagination? Should people only be investing in digital assets like Bitcoin? There's a whole movement, if you like, against fiat money. And that alt-right kind of philosophy leans into that whole de-dollarization or debasement trade as well. We saw that step change happen with the dollar when the tariff announcements come through. It didn't weaken that much further, but we saw another round of weakening earlier this year where concerns around central bank independence. Because Trump has so vocally gone after Powell, even though he's retiring only in May, he's had Powell has subpoenas issued against him. They're looking into kind of corruption charges and cost overruns. That questioning of the central bank independence is one of the key tenets to dollar stability. And so the debasement trade got a second leg, if you like, first of all with tariffs, but secondly with fears around central bank independence. So when Trump nominated Kevin Walsh as a competent pair of hands, there was broad relief in the dollar market and the dollar recovered its gains. And even Trump himself has been saying, I can make the dollar go up and down like a yo-yo. And just to prove the point, in the month of January, February, he's done almost exactly that. The dollar's nosedived over concerns around central bank independence, only to rally as a sensible appointment came onto the horizon. So what do you buy on the other side of the debasement trade? If you're worried about treasuries, US treasuries, and being just worth the paper they're written on, if you're worried about fiat money, like the dollars in your pockets or the pounds in your pockets, what things do you actually buy if you believe that debasement is risk? Well, if you're an old school investor, you'd buy gold and precious metals, gold, silver, platinum, palladium, things that have core value, real assets that got core value, even if they don't produce an income, even if it's seen as more of a unit of currency rather than a unit of return. So that's been one thing that's done very well in 2025, extending in 2026. And if you're into digital assets, then the crypto bros, they believe that Bitcoin and crypto assets are a kind of scarcity token that should perform well as part of the debasement trade. But what's interesting is that whereas it has worked out for gold, it's been much harder and still to be proven for crypto, with Bitcoin being more of a sentiment about flows than it is about a store of value. So when you saw kind of everything decline with the kind of concerns around Trump and the Fed, equities were down, but also crypto was down and gold was down. So where do you actually hide? The challenge around actually positioning a portfolio for a debasement trade is around two aspects. One, layering. The second, timing. So layering means having different parts of real assets included in an alternative strategy, like copper, like gold, that can preserve value when fiat money is in question, but pairing that with other income generative assets like infrastructure, like utilities, and also other shock absorbers like energy. There's a layering of what you actually use, but there's also the timing of the entry points of when to actually access those exposures. And if it's hard to time the markets in normal times, it's even harder when times are as volatile and as extenuous like this. And that way we want to have this layered and continuous approach where to build up diversification slowly.